program. The views expressed are not necessarily those of the management or ownership of KSTP-AM 1500 ESPN.
The following is a presentation of Cover Your Assets and is offered by Rooker Financial Coaching and Consulting. You're trying to build your income, your business, your life. Challenges are all around you. It seems so overwhelming. People are depending on you. Who do you listen to? Where can you go to find honest, useful information?
Todd Rooker.
For decades, Todd Rooker has been teaching professional education to attorneys, CPAs, bankers, and financial advisors. Rooker Financial Consulting offers advice and coaching to consumers, business owners, and financial professionals on every topic imaginable. If you truly want to succeed, sit back and find out how to cover and build your assets. Here's nationally renowned speaker and expert getting you on the path to financial strength and wealth, Todd Rooker.
Morning, everyone. How are you doing this morning? Beautiful, beautiful morning. Going to be a little bit hot here for the next few weeks, but hey, that's what summer is, and that's what we wait for, right? So today, I think we have a great show lined up for you. That show is going to be about entering retirement. And for a lot of you, you hear me say I'm never going to retire until they plug me in the ground. But for probably 95% of you, you are looking forward to and want to retire. And so we have retirement specialist and financial advisor Jim Baer. Jim is with J. Allen Financial in Maple Grove. And he is going to be answering hopefully some of the most frequently asked questions, answering those questions, and giving you some exceedingly good information for those of you who are already in retirement, those of you who are looking to enter retirement, and frankly, you can't start thinking about these things early enough. So, Jim, with that, welcome to the show this morning.
Thank you for having me, Todd.
Well, very good, very good. We are always excited to talk money, and certainly that's what this is about.
Yes, it is.
So let's, first of all, tell people a little bit about yourself. We've had you on before, but
Yes.
Just give people a little review of who you are, what you do, and how people can find you should they want to do that after listening to the show.
You bet. I am an investment advisor representative with AE Wealth Management, and I own my own firm, J. Allen Financial, which I started about 22 years ago. Next month, I'll be 35 years in the business, which is hard to believe.
Wow.
So I'm located in Maple Grove, and for the listeners that want to know a little bit more about me, enterretirement.com is my website. Jim at enterretirement is my email address, and my phone number is 763-657-1828. And I work with baby boomers on a regular basis, helping them enter retirement and stay retired.
Very good. And listen, for those of you, I have some inside knowledge about the advisory business, having been in it for several decades. It is no small thing to survive, as Jim has for over 30 years. It is not an easy business. And when you make it that long, you must be doing something right, must be trustworthy, and must be doing a good job for clients, or frankly, you wouldn't still be here. And I sincerely mean that.
Thank you.
So we're going to talk today about the number one thing that people are going to be looking for that your life and your lifestyle costs revolve around. Well, imagine that that's going to be gone, and those dollars need to be replaced with an income stream coming from potentially your Social Security, maybe if you're old enough to have a pension plan, and then, of course, your other investments. And you're looking to those lump sums to be able to create an income stream that you can live off of, not unlike the earned income that you received in your paycheck. So when do you start, when should you start concerning yourself with Social Security and retirement income, Jim?
Yeah, it's a good question. If I knew when you were going to die, I could tell you exactly when we should start Social Security. I hate to be that pointing with it, but what I've learned is without income, there is no retirement. And about 40% of our income is going to come from Social Security. So I think it's really important we find the right start date for the listeners, and it is different for everyone that I talk to. A few things to keep in mind that when you go to this process of deciding when to take Social Security, there's a few facts I think people need to understand. Number one, the formula for it is your highest 35 years of earnings. is what's going to go into the calculation for Social Security. The minimum side of it, you have to have 40 quarters or 10 years of earnings in order to qualify for a retirement benefit. So sometimes that right there starts to filter it out, and people want to work a little bit longer because they're dropping off some lower years and picking up some higher years to improve that monthly check. The second thing is you can take it as early as 62, but you can wait as late as 70 to take your benefit. So 62 is called an early benefit, 70 is called a full or maximum benefit, and in between there is a date called full retirement age. Which is different depending on your year of birth. It used to be 65 for everybody. And I know when you started in the industry, that's pretty much what everyone lived by. Now that has inched ever so older for the younger generation especially. So 67 is the highest or the longest it could be for full retirement. It could be as early as 66, depending on, again, on the year of birth. So I find that many people will probably take their benefit too early. The reason being is maybe they're excited to get a check at 62, and maybe they feel like they could pay off their mortgage if they take that check and then retire later. It's when you combine the taking the benefit before your full retirement age and you keep working, that's kind of a recipe for what I think is disaster. Because if you earn too much money in that little pocket of time, you have to start paying back some of that Social Security. So it's roughly $20,000 of earnings if you go above that number and you're collecting Social Security.
So this would be assuming if you continue to work when you were collecting.
Absolutely. So if someone started at 62 or any time before their full retirement age, kept working and made over 20 grand, now you've got a situation where you're paying back for every $2 above that number, $1 of Social Security benefits. And the kicker is, once you've received your 12th check from Social Security, it is now irrevocable. So I have people think twice before they take it that early.
So ideally, you would want to actually be physically retired in so much as you're not working before you begin taking that benefit.
I think as a general statement, that would probably be a good rule of thumb.
Another thing that is important to note is the escalation or increasing amount that you receive year over year in how long you delay all the way to age 70. Why don't you talk about that a little bit?
Yeah, once that individual reaches full retirement age, you get an 8% increase every year that you wait. And it is pro rata, so if you wait 6 months, you would get 4%. So that 8% compounding is
huge,
pretty good.
Yeah.
And especially when I see maybe second marriages where there's an age gap between the husband and the wife, as an example, of maybe 6, 7+ years. Waiting on that benefit to as late as possible helps for the survivor, because now we're planning for 2 life expectancies instead of 1. And what happens with Social Security is a husband and wife situation. They both are collecting checks, but upon the first death, the survivor gets to elect the higher of the 2 checks for their lifetime. So waiting as late as possible on that check for the older spouse, especially if it's a man. Statistically, men die before women. You might be setting up the surviving spouse for a really high check from Social Security.
So earned income for as long as you can earn it all the way to age 70 is probably the way to go. Being able to have a compounded increase of 8% is just, folks, if you don't know, extraordinary. Frankly, for most people who are investing over their working lifetimes, although they're getting quarterly and annually reports, they're showing what their investment funds are doing. First, know that that's what the fund is doing, not necessarily what you're doing. And second of all, that's blended as a rate of return overall with a percentage of your funds that more often are going to be placed in bonds, which may be 30, 40% or more. And so consequently, you take those two and you have a blended return. So when you're talking about somebody earning over the course of a working life 6 to 8% when they are in actively traded stocks, thereby mutual funds, to be able to get an 8% increase year over year in your Social Security is just extraordinary. I just want to highlight that. Another point that you brought up that I think maybe some might be thinking about is that if I am self-employed, I may be, if I own my own business, I very well may be paying myself a salary and to draw. Now, the significance of that is that the salary most often, if I'm either an LLC or an S Corp, and an LLC being declared a subchapter S for tax purposes, gives me the ability to receive salary with that Social Security. And when you do that, you're typically paying both sides of it, the employer and the employee side, because you are both in that instance, where if you're a bona fide employee, the employer is paying one half of that Social Security cost and you are. It's about 15%, 15.4, I think, percent, which is a lot of money. But everything you take on draw thereafter, you're not paying that tax. You get to take as a draw as though you're an investor in the business, and you're kind of both. You're an active participant and you're an investor. Well, one thing that might be worth noting is that if I'm trying to accentuate the greatest amount of Social Security income, I might want to take more salary during the final period of my life to be able to get the maximum benefit in Social Security leading up to the time that I actually turn that switch on. And or if I'm an employee, if I have the capacity to work more, make more, and pay more in Social Security, here again, I'm able to take advantage of the highest potential benefit that I can get, and I actually am able to position myself to be able to do that. Am I right or am I wrong about that?
You're absolutely right on that. And that's where, someone like Arliss Cleveland can come in as a CPA, good CPA, a part of the show. And financial planners, we address that topic all the time. If we're trying to just round up that benefit, get a little bit higher, that really would be the formula to work with.
I want to make another point here, folks. Jim is a retirement specialist. I will tell you that I was in the business for a long time, and we were focused on assets under management. And frankly, all day, every day, we talked about retirement with our clients. But the reality is we never really wanted them to get out of the active market. We never really wanted them to retire. It's a dirty little secret. When you specialize in retirement, as Jim does, that is exactly what you're doing. And in all fairness, your traditional financial advisor, whom you may have had for years and years and years, really isn't acclimated for positioning in retirement. It's just not their business. Their business is about active management and funds that are in the market. And when you get into the retirement stage of your life, you need consistent income. And there's an important point to be made about this. Jim and I have talked about this many times, and we all know that. But a perfect example is right now. We are in a market right now where the majority, and correlated or non-correlated, the majority of the market is down. And so for a lot of you listening to this, undoubtedly your portfolio overall is down in its value. Well, the issue with that is that when you're young, you don't have to worry about that because you have earned income, and that earned income pays your bills, and the money that's in your investment accounts, and if you're dollar cost averaging, putting a particular amount in month over month, you really don't care because you know that the market, or you believe the market, will come back. And when that market comes back, you're going to own as many or more shares of whatever it is you own, and you're going to enjoy the bounce or the benefit of the increased pricing that goes along. The problem is when you need income, if the market is down, you have to sell more of what you have, more shares. And as a result, when you do that, you have less shares to enjoy the benefit of the bounce because you need income, and you need to do that every single month. So when the market is high, well, you sell less. When the market is low, you have to sell more. That is exceedingly problematic when you get to a point where you need income, because that means you're going to run through your money a whole lot faster. So Jim is a specialist in putting you into investments where you can enjoy a consistent amount and not concern yourself with those fluctuations. And wherever you are in your life, if you're nearing retirement, you need to begin to consider divesting of the active market and moving into things that are consistent and predictable so that you don't have to worry about those things in retirement. Is that correct or not, Jim?
Yeah, it is. It seems to be the theme of the week, Todd, in the office is securing some of the portfolio to make sure it doesn't go down any further, which there are ways to do that with, like insurance products, annuities, and just making sure that we've got some floor inside their investment. Because right now people are looking for, give me a floor.
They're looking for guarantees.
They're looking for guarantees, and insurance companies are a great spot to go for that.
So when I take the Social Security that we've just discussed, am I going to be paying taxes on that Social Security?
If that's all you took and put on your tax return, if you had no other income at all, it would be 100% tax-free.
Okay.
But most of our listeners today can't live off of Social Security. Social Security was never designed to be 100% of your retirement income. It's Social Security Administration says it's only about 40% of your income. So we add the other sources of income. So if we're talking to our listeners today who are involved in real estate and getting income as a result of that, maybe they're at an age where they have to take money out of their 401k, or if they decided to do that, or a pension, as you mentioned. That all gets added together on your tax return to determine if your Social Security will be taxed. If it's taxed, it's two brackets. Half of your Social Security is taxed at whatever your income bracket is, or 85% of it is taxed at your current tax bracket. So another way of saying it is 15% of your Social Security will be tax-free, maybe 100%, but I would say most listeners today are probably going to be in that 85% bracket. Of what 85% of the Social Security will be taxed.
Well, and frankly, folks, that is a good thing, because I think it's just a real fallacy. I don't know where it began or how long it's been perpetuated, but the notion that you're going to live on Social Security is not a real thing, folks. And unless you desire to live in poverty, the reality is Social Security in today's world is most certainly not going to fund somebody's retirement.
No, it's not.
And especially with the longevity of a lot of folks, we're living longer and longer. And the other thing that you should keep in mind, folks, is that a lot of the retirement information that you hear out there is predicated on mortality. Mortality being average death of a given group of people. Jim just mentioned the baby boomers, Generation X, millennials, whomever it is. They're looking at the average death, which means half of the people who are in that group are going to live shorter and half are going to live longer. So remember that when you consider some of the statistics and the information that you're reading, if you plan to live longer than the average person, if you're doing your best to live a healthy lifestyle, you might have a different scenario than what you're hearing in the statistics.
Yep, that is true.
So Jim's phone number is 763-657-1828. His website is enterretirement.com. We are going to take a little break here, and we're going to come back, and we're going to talk about 401ks and IRAs. And for any of you who actually don't want to discount any of you, we're really talking about retirement plans. And so when we think about that, just think about an umbrella sheltering the investments that you have from taxation raining down and taking away from them. And that means that SEP, Roth, Keogh, 401k, 403b, IRA, they're all falling in that, just varying flavors with a little bit different rules related to them. So we're going to come back. We're going to talk about that. And that will hopefully help you learn a little bit about how you need to subsidize your Social Security. And remember, wherever you are, you can contribute more and you can position yourself for retirement. And Jim is here to help. We'll be right back. Does your sump pump run constantly? Do you want to ensure that you never have a damp, musty-smelling basement? These issues are caused by water coming off your roof, draining into your basement. Gutters can resolve these problems. William Foss is the owner of Seamless Solutions. He is honest and trustworthy. He is simply the best. If you need gutters or leaf covers, he is the guy to call. You can call him at 612-834-0664 or go to his website, seamlesssolutionsmn.com.
Are you looking for a bank that supports entrepreneurs like you? If you're searching for a bank to grow with you and your business, I would like to welcome you to our village, Village Bank. Hi, I'm Alicia Webb, President and Vice Chair of Village Bank. I'm honored to lead Village Bank, an entrepreneur's bank that was built by an entrepreneur and for entrepreneurs. Starting a business and then maintaining it requires mindset. It's important for business owners to realize that financial statements aren't just for their bankers and accountants. Knowing your numbers will help build the foundation for you and a healthy and successful business. You don't have to be a financial expert nor a banker, but you do need to understand a few key financial documents and metrics to make your business successful. Follow us on Facebook and LinkedIn or visit us at villagebankonline.com. It takes a village to accomplish your business goals. And be sure to tune in to Cover Your Assets the last Saturday of every month to fill your entrepreneurial cup of ambition and start your Saturday off right with me, Alicia Webb, and our village, Village Bank.
Fix Auto has been the collision repair leader in the Twin Cities for over 40 years. Hi, I'm Matt Feehan, second-generation owner. Our mission at Fix Auto is to provide you with the simplest collision repair experience anywhere. If you're in an accident and you need help, my team is here and ready for you. You can find us on the web at fixautousa.com. That's fixautousa.com. We are Fix Auto, home of the WOW experience.
He can lift a bus straight over his head. He can fly around the world in seconds. And he has the power to regenerate entire limbs.
Okay, so Jason Walgrave isn't actually a superhero. But once you visit his website to find out what he knows about real estate, you may start to think he's superhuman. That's because at jasonwalgrave.com, you'll find absolutely anything you need to know about real estate in the Twin Cities. Whether you're looking to buy or sell your home, check out jasonwalgrave.com, the #1 place for all your real estate questions.
Finding a good banker and CPA are like having a good doctor or mechanic. You cannot fully appreciate the value they represent until you're in a pinch and truly need them. However, that's not the time to go looking for one. Instead, you want to position and strategize well in advance for a favorable outcome. CPA Arliss Cleveland of Arliss Cleveland LTD is the CPA firm you've been looking for. As many of you already know, if you're looking for a great CPA, Arliss Cleveland gets my highest endorsement. Arliss Cleveland LTD has now formed a strategic relationship with Village Bank, conveniently located in the Village Bank building, located at 9298 Central Avenue North, Suite 412, Blaine, Minnesota. You can also find Arliss Cleveland LTD's certified public accountants and consultants by going to accountingoffices.net or by simply calling 763-786-0639. That contact information again, accounting-offices.net or by simply calling 763-786-0639.
You're listening to Cover Your Assets with Todd Rooker.
Welcome back, everybody. We are again here with Jim Baer. Jim is with J. Allen Financial. That is his own firm. He's been in business for several decades. We'll leave it at that. He is a financial advisor and a retirement specialist. Jim is going to be doing a workshop. You heard us talking about Social Security, and we're going to be rolling into your qualified retirement accounts and how that all works together. Well, Jim is going to be doing a seminar, a few of them actually, that you can attend for free. Is that right, Jim?
That's correct.
All right. And that they'll be taking place August 3rd at 10 a.m. in the morning and also August 3rd at 6 p.m. Then there's another one, August 11th at 6 p.m. Where will those be held, Jim?
Maple Grove at the Maple Grove Community Center.
Very good. And if you need more information, you can go to Jim's website. That website address is www.enterretirement.com. I always forget that we don't need to do the WW anymore. But, you know, at least people know. So enterretirement.com. And then you can also, if you like, you can email Jim. And that email address is jim@enterretirement.com. That's a catchy one. I like that. So now let us roll into retirement. And again, I tried to at the top of the break let you know that, you know, all of your retirement plans, regardless of what they're called, if they have special tax treatment, we're most likely talking about a retirement account. And so the question is, should I roll my 401k, my IRA, or what have you, over into a self-directed IRA? Should I be doing that? Should that be something I should consider?
Depends. Sometimes I hold up a package of dependent diapers to illustrate this point. Every situation is a little different. I'll tell you why there's maybe a couple reasons to keep it in a 401k. If you're in that age group between 55 and 59 and a half, and you were planning on using that asset for a withdrawal schedule or any sort of withdrawal, you'd want to keep it right where it's at because it has special tax treatment. There's no 10% penalty for taking that money out. The second thing might be expenses, might be a lot lower. But I think both of those are kind of a whisper when you think of the other reasons why you would want to maybe roll that out. Ideally, when you have investments, you would like to be able to have some voice in how those investments can be invested. When you're in a 401k, you're a participant. You're not an owner. You don't have any say on what choices are available to you. And it might be 7 choices and you have to choose the best of the 7. Or it might be a very robust where you've got sky's the limit. Very few 401ks do I find that it's a very robust find. Rolling it over to an IRA allows people to open up to the self-directed world.
Meaning that robust being highly individualized.
Very individualized. And I think probably the one area people are looking for right now is what can I do for safety of my investments right now? There's not a lot of conservative investments built into a 401k. So when you get into that IRA world, now you have a lot of choices for the conservative investor or a portion of the portfolio. So it becomes more of a customization of, if I want to retire in 3 years, we should be taking some risk off the table. If I have, 20 years ahead of me, we might want to take a little bit more risk with our money. So being able to get into certain sectors.
So that means divesting of stocks.
Yes.
And moving into more predictable investments that where, as you say, the floor is only so low and I can only lose so much.
That's correct.
Okay. Just want to make sure we're all
That
right.
is correct.
So when I consider doing that, is there any, so when you use 3 years versus 20 years, is there age groups that I might, you might say more often than not, and I know there's no guarantees on any of this stuff, but is there an age group that you would say, listen, you should be contributing to a Roth versus a traditional contribution to your retirement account? Is that a thing or is that not a thing?
It is a thing. And let me just clarify what we mean by contribution versus rollover.
Right.
So when we have a rollover, we have accumulated money already, and we're contemplating moving that from one account to a different account. Contribution is where you're actually opening up the checkbook, if we know what a checkbook still is, and we're writing a check to make a contribution to an account. So contributions carry different limits than rollovers. So if we're contemplating a Roth IRA, we are going to be limited to how much we can put in every year. So $7,000 for the listeners that are over 50, $6,000 if you're under 50. That's all you can put in for a new contribution. When you're in the 401k world, those limits are much higher. It's $27,000 for those of us that are over 50. It's $20,500 if you're over 50. So the limits are a lot higher inside of the 401k world.
So I didn't catch the differences, but my recollection is there's a $6,000 catch-up provision once you reach 50 years old. Is that higher now?
It went up this year to $6,500.
Okay, very good.
Yep.
So just to take you back, folks, and make sure that we're not losing anybody, a lot of you may be doing a traditional 401k. Maybe you talk to your advisor who tells you, well, you can't do a Roth, or you can only do a Roth of $5,000 or $6,000, whatever it happens to be. More often than not, the reason that point is being made to you is because you're already contributing to in a traditional contribution to a 401k, and so consequently you're limited by what you can do above and beyond that. However, federally mandated changes are making employers move to a point where all of their employees are going to be able to determine if they want to do a Roth contribution, which is an after-tax contribution, versus a traditional contribution, which is before, where you don't pay taxes until you take it at retirement time. So when Jim is talking about, age groups typically being younger, where it's almost an automatic that they should consider a Roth, if your company does not offer a Roth contribution, inquire that why they have not, and they can choose to opt into those changes that are taking place more quickly, and then you'll have that availability. Is that right, Jim?
Absolutely. Younger investors should most definitely be looking at the Roth 401k or the Roth IRA. Just that compounding story gets so good. And the reason why we keep talking about Roth and how it's so wonderful is when you ultimately take that money out, if you've waited 5 years from your first contribution, you're over 59 and a half, all of that money is tax-free.
Very good. Very good. The other thing, too, that I'll bring up, folks, is that if you are involved, most of you who are investing, I'll just take you back to my world where I remember people saying to me, yeah, I want the highest rate of return, Todd, but I don't want to take any risks. Which, of course, that really represents the majority of you whom are out there. Nevertheless, all of you have a goal of succeeding in your investments. And the one thing you should know is that when you're making a contribution, a traditional contribution, you're going to pay income taxes on all of the money, not just the money that you didn't pay taxes on that you were able to forego taxes until you took it at retirement, but also all of the money that the money made, that being the gain. So if you are positioning to have highly appreciated investments, that speaks even more strongly that you should be considering a Roth versus a traditional retirement account.
Absolutely.
Contribution.
The younger, the better. The Roth is kind of the new kid on the block. It only came around in 1997, so we're 25 years old. So a lot of the listeners, including myself, we didn't have access to that when we first started investing. And if you started your Roth in the 401k world, that came later, 2006. So there's still been a lot of, I don't know if I should do that. And I think one thing for the listeners to understand, if we're looking at the 401k Roth as an option, you may or may not get matching on that contribution. So it's something to consider if you're going to go in that direction. That's why it's so important to have conversation with an advisor just to see the pros and cons of everything. That's our job, to make sure we look at everything from a 360-degree circle to see here are the pros and cons of that. What makes sense for you.
Very good. And so as you listen to this, know that most of you are not fully funding your retirement account. When Jim brings up the numbers of 20,000 and 27,000, just know, having been in that business, the number of people who are actually fully funding on a yearly basis is not that high. So when Jim talks about that, you might want to consider, depending on how much you're putting away on a monthly basis, you might want to consider maxing out or maximizing the match contribution with your employer, and then by getting a Roth as well, because chances are you're not even coming close to going to the maximum anyway, and you'd be able to take advantage of both of those things.
Right. Can you start Monday?
Yeah.
That's great advice. That's exactly right. Get that matching. Consider putting the rest into the Roth. Can be a good strategy in your situation.
Very good. Very good.
And just as a note, employees that I'm talking to out there who maybe realize, hey, I should put more money away, you can up that at any time. You can go to the 401k, your benefits wherever you go for that. And I've had people who the second half of the year, go to 100% salary and max it out. Just get it done by the end of the year.
Absolutely. Absolutely. And look, for a lot of folks, that makes tremendous sense to do that. And that's also why your tax position is so critical in your decision-making of investing. And look, I'm well aware that it generally isn't. People aren't taking advantage of that information, but really you should be, because it can make all the difference in the world. And here's another point that you've heard me make many times. Often, tax efficiency is more important than investment return, because investment return is speculative. You don't know what you're going to get until the year is up. But with a tax strategy that's going to save you 5, 10, 15% on your taxable income, that is a guarantee, and that's a powerful thing.
It sure is. It sure is.
All right, we're going to take another break here, and we're going to talk about something that I think is very much an issue, and that is, when do I have to take money out of my IRA? And if I don't, I get taxed anyway. We're going to be talking about required minimum distributions, or RMDs, and that is an incredibly important conversation. We'll be right back with Jim Baer with J. Allen Financial. We'll be right back. Hey, are you considering something exceptional to set your home apart and highlight its curb appeal? How about the rich look of custom copper gutters? Copper gutters are not only beautiful, they also offer timeless durability. William Foss with Gutter Solutions installed my beautiful copper gutters. I get compliments every day. If you're looking for extraordinary craftsmanship and would like to consider something truly special, call him at 612-834-0664 or go to their website, seamlesssolutionsmn.com. Ask for Billy. I have trusted attorney Brian Aho for more than 10 years to work closely with me to resolve and eliminate debt for many of my personal and business clients. Aho Law Office is the go-to firm I choose because Brian has always been caring and compassionate with my clients, while tenaciously fighting to retain as much of their assets as possible while quickly eliminating their debt. Brian's extensive experience and knowledge of bankruptcy law and willingness to fight allow him to resolve challenges and cases that many attorneys won't. Don't let other attorneys learn on your dime. Rely on the experience of Aho Law Office to help you achieve relief from your creditors. Competent, compassionate legal advocates providing the clarity to protect tomorrow. For more information, call Brian and his staff at 612-271-4047 or email Brian directly at brian@aholawoffice.com. Again, that number, 612-271-4047.
Hi, I'm Kimberly Nybo with the Kimberly Nybo Insurance Agency, serving the community for over 27 years. People tend to be most concerned with price. That is, of course, until something goes wrong. Then the only thing they care about is their coverage. My experience enables me to uncover every available discount. I could save you up to 40%, while still offering the proper coverage for the people you care about. Call today for a free review at 763-571-6111 or email me at kim@kimnybo.com.
Hi, this is Troy Danner of Danner's Cabinet Shop. My family has been building custom cabinets and countertops for homes in Minnesota for over 50 years. We still make the cabinets the way my grandpa did when he founded our company. My team of skilled craftsmen pride themselves on attention to detail and making sure every element of your project goes perfectly. Give me a call at 763-753-4002 or visit us online at dannerscabinets.com.
Mike Overson here of Minnesota Home Talk. With today's housing market, buying a house is a competition. To win in a multiple offer situation, you have to work with a local lender who has the reputation of being 100% reliable. Come to the winning team. Get pre-approved for your loan by one of the top lenders in the nation, the Mike Overson Mortgage Team at Luminate Home Loans. We will help you win. Call me at 612-202-8321. That's Mike Overson at 612-202-8321 or go to applywithmike.com.
Todd Rooker here to tell you about the most amazing jewelry store, Golden Treasures on 805 Grand Avenue in St. Paul. I've known the owner, Todd Gimble, for almost 20 years now, and at Golden Treasures, not only do you get more for less, it's the experience that you and your special person will feel when you walk in the door. Todd truly puts his heart and soul into creating your experience regardless of how much money you spend. This is Todd's customer for life philosophy. Take it from me, there really is no other jewelry store. You can't go wrong with Golden Treasures in St. Paul. 651-227-2711. That's 651-227-2711. Finding a good banker and CPA are like having a good doctor or mechanic. You cannot fully appreciate the value they represent until you're in a pinch and truly need them. However, that's not the time to go looking for one. Instead, you want to position and strategize well in advance for a favorable outcome. CPA Arliss Cleveland of Arliss Cleveland LTD is the CPA firm you've been looking for. As many of you already know, if you're looking for a great CPA, Arliss Cleveland gets my highest endorsement. Arliss Cleveland LTD has now formed a strategic relationship with Village Bank, conveniently located in the Village Bank building, located at 9298 Central Avenue North, Suite 412, Blaine, Minnesota. You can also find Arliss Cleveland LTD certified public accountants and consultants by going to accountingoffices.net or by simply calling 763-786-0639. That contact information again, accounting-offices.net or by simply calling 763-786-0639.
You're listening to Cover Your Assets with Todd Rooker.
Welcome back, everybody. Again, we are speaking with Jim Baer from J. Allen Financial. Jim is not only a financial advisor, but he is a retirement specialist. Jim is going to be doing workshops in August. The first one that you want to write down is August 3rd at 10 a.m. and also another one, August 3rd, in the evening at 6 p.m. and then August 11th at 6 p.m. And Jim, where are those taking place?
Maple Grove, Minnesota, at the community center.
Very good. And if you want more information, you can go to Jim's website, and his website address is enterretirement.com. His email address is jim@enterretirement.com. So we are going to be talking about something that is very important, and that is RMD. So as we just concluded a conversation about conversion from traditional contributions or traditional retirement accounts to a Roth, this RMD, required minimum distribution, becomes a really important point because some of the reasons that you might want to convert to a Roth might have to do with the fact that there are RMDs. So would you first explain, Jim, what is an RMD and how might that relate to your taxation?
You bet. An RMD stands for required minimum distribution. And when we all started putting money away into an IRA or 401k, we were always told that when you reach the age of 70 and a half, you have to start taking money out of your pre-tax account, 401k, IRA. That changed at the end of 2019, and it got lost on a lot of people because beginning of 2020, we were kind of distracted with everything going on in the world. So that age got pushed out to 72, which is a good thing, especially for the audience members who are savers, who really don't want to take this money out. They'd rather let it compound. For those that were planning on taking it at 70 and a half, you're still eligible to do that. It's just you now have the potential for another 1 or 2 tax years of additional growth if you want to take that out. So for a listener, this might be turning 72 this year. So someone who was born in 1950, they're turning 72 this year. What's going to happen is we're going to take the value of that account from December 31st of last year. We're going to multiply that times the table, which is about, call it 4% for simple math. And that's the amount of money that has to come out this year. If we don't take it out, you do get a little bit of grace to take it out before April 1st. But if you still don't take it out, then it's a 50% penalty. So if $10,000 is what's supposed to come out, you've got to pay $5,000 in taxes, and you still have to take that $10,000 and pay taxes on it. So it's really not worth it to just ignore it.
And so, how does the treatment of a Roth compare with that?
Well, the treatment of a Roth compares this.
Or Roth money, I guess we should
Roth
say.
money, yeah. So if that same individual born in 1950 is turning 72 and they've got their money in a Roth, there's no required minimum distribution. They could just stare at that asset and let it grow, which is really important right now. As you mentioned at the beginning of the show, I think it's a broad-based statement. Most investment accounts are down this year. And to be able to give time to that money to grow back is really valuable, and missing out on maybe an upswing in the market at a time where you have to take the money out.
So when you're contributing folks in a Roth, you're going to pay the tax right up front. When you do a traditional contribution, you're going to forego the tax. However, down the road, you're going to be contending with paying income tax on not just the money that you contributed in, but also what the money has grown into at that time, as well as RMD. So you avoid those two things when you have a Roth contribution, and overall at the end, you've got now a Roth investment. And so you avoid that because at the end, there is no tax. So you get to take all that money, and there's no pressure to take it and pay taxes on it because you've already paid taxes on it. And so, you know, for most of the young folks, you should be listening intently to this. And for those of you who are a little bit older, I suggest that you give Jim a call, and he can tell you a little bit more about that. Now, Jim does a free retirement analysis. This is, in my estimation, one of the single most valuable services that an advisor can give you. And when you're dealing with somebody like Jim, who is a retirement specialist, the value of that analysis is almost unspeakable. It really is, because to know where you are and to be able to have time to adjust to where you want to be is invaluable. Now, my challenge, Jim, is I know many people think, I just don't want to know. And as though if I don't know, everything will be okay.
There was a commercial years ago that had this actor that had a shirt that said retirement on it. And he was chasing people around the street, and they were running away from him. And I thought it was so well put out there. And you're right. Some people just, I just want to put my head in the sand and not look at it. But it's so important just to look at it, understand where you're at. Let's find the you are here dot for your retirement plan and see what we need to do to get to that destination called retirement. And let's put a retirement date on the calendar. It's really fun to do.
Very good. Very good. And so, again, if you want to reach out to Jim, Jim's website address is www.enterretirement.com. His email address is jim@enterretirement.com. And his phone number, 763-657-1828. All right. So next, What can I do to reduce my taxes when I have to take money out of my IRA? Remember I said earlier, tax efficiency can be more important than investment return, and tax strategy in retirement, frankly, is a huge part of what Jim actually does.
Not what you make, it's what you keep.
Yes,
right?
yes.
So a couple strategies. We talked about the Roth conversion. And again, as a reminder, that is values you have right now in an IRA or a 401k, taking some of that value and putting it into a Roth. That's called a conversion. So if that's your situation, and you're in your 50s to maybe mid-60s, I think there's a conversation there to talk about moving some of that money into a Roth. And I say some carefully because if you look at the whole value that you have right now and you consider what the tax liability would be to convert everything, you would probably not want to write that check to the IRS. That would be a very big check. But consider you've got a wonderful opportunity right now, in my opinion, for planning because of a lot of investments are down right now. So converting a down asset into a Roth account with the idea that eventually things turn around and appreciate in value, all that appreciation now is tax-free. So doing a little bit every year is another strategy where if you look at your tax bracket, so with the help of like an Arliss Cleveland or your whoever helps you with your taxes, identify how much room do you have left in your current tax bracket. And consider converting an IRA or a 401k equal to that amount to a Roth account to keep you in the same bracket that you're in. So if you're of the belief that markets are going to go higher, if you're of the belief that taxes are going to go higher, which I think it's a foregone conclusion in my opinion, then that would be the recipe for this sort of a planning for that. And so think about it, someone who's in their 50s and maybe 10 years ahead of retirement could slowly convert all of their pre-tax money to a Roth. Now we get to 72. There's no required minimum distribution. All that money is now tax-free, and that money is just going to go a lot further in retirement if we don't have any tax liability attached to it.
Very good. And the reason that we would do that incrementally over time is
to soften the tax liability. Otherwise, you could be popping yourself up to maybe 2-3 brackets higher than what you're at.
Right. And not to mention the fact that where you are in terms of income in that year and where taxes are in that year could be exceedingly high. Now, and so think about it. It's kind of like people who think they're bright because they're trying to time the market, and frankly, the very best and brightest can't do it, don't do it. And so what you're really talking about when you do things over time, if you take your portfolio and you break it into pieces and you incrementally do it over a predictable period of time, what you're really doing is dollar cost averaging into it so that you get an average tax rate over time as opposed to getting killed at one time, right?
Well said.
Very good.
That's exactly right.
All right. So what should I take money out of my IRA to pay off my mortgage? I get this one continuously. So what do you think about that?
Both of us do. I think for the most part, no. Of course, we don't know the numbers that we're talking about in this hypothetical situation, but I think people in general fail to realize how much taxes they have to pay when they do something like this. So kind of to our previous conversation, it's in the context of what's on your tax return already. And when we add this 401k money on top of it or an IRA, again, that could put you in a higher tax bracket. And if you're under 59.5, you're talking about a 10% penalty on top of Minnesota, on top of federal. You could see numbers like 40, 50% that you'd have to take out. And so if you're looking to get, 60 grand to pay off your mortgage, you might have to take 100 grand out of your 401k or IRA on top of the fact that that's already depressed by probably 25 grand.
Not to mention the fact that a lot of people who want to do this, Jim, are sitting on mortgage rates of 3% and sometimes less. Folks, that is cheap money. Cheap money. And even if your investments, fixed or variable, are producing a small return on investment, I'll bet you still it beats the heck out of your 2.875 that you got on your mortgage. So the idea that you want to lose the leverage of having the money be more productive in the investments than putting it into paying down the mortgage is a terrible idea. So I'll just tell you from my perspective, this is not Jim, this is me. I am always looking at this and saying, how do I get the most leverage out of the money? Where am I making the most money? And the reality is that a mortgage, when you're, and when you've got interest rates that are 7%, okay, that's maybe a different conversation. But when you've got these exceedingly low interest rates and you can keep that money working for you, the leverage is in keeping the money active in the market. And so realistically, in most cases, paying off a mortgage is not really a great financial strategy. It's more a security issue for people.
It is.
That's the reality.
And I think the mind shift that can happen here is maybe turn income on from that asset to pay the mortgage. In effect,
is this a good topic?
You don't have that burden.
Jim, let's come back and let's talk about that. Turn income on. Let's talk about that. We're going to take another break here real quick, and we will be right back with Jim Baer from J. Allen Financial. You can give him a call, 763-657-1828. You can also go to his website, enterretirement.com, or you can email him at jim@enterretirement.com. Jim is doing a few workshops. August 3rd, he's doing one at 10 a.m., and another one the same day at 6 p.m., and then another one again on August 11th at 6 p.m., and that again is at, Jim?
Maple Grove Community Center.
Great. We'll be right back.
Hello, I'd like to talk with you about financial coaching. Traditional financial planners help you make decisions about stocks, bonds, and mutual funds with money you already have. That's great, but who helps you accumulate more money in the first place? Who helps you make day-by-day life decisions? Who isn't trying to sell you something? Like, should I go back to school? Am I wasting money on insurance? How to purchase and finance a car, boat, home, lake cabin, or investment property? How to start, manage, and sell a business? It's about making minor errors that become colossal mistakes and cost you hundreds of thousands of dollars over your lifetime. The problem is that you're so busy pursuing your career that you're forced to make critical financial decisions that have a dramatic long-term effect on your finances without adequate research or information. Rooker Financial Coaching is like having a personal CFO for every decision. Don't waste time lamenting the bad decisions of the past or money that's run through your fingertips. Stop procrastinating. Call Rooker Financial Coaching, 763-559-3800. That's 763-559-3800. Call me today, Todd Rooker, 763-559-3800. That's 763-559-3800.
I have trusted attorney Brian Aho for more than 10 years to work closely with me to resolve and eliminate debt for many of my personal and business clients. Aho Law Office is the go-to firm I choose because Brian has always been caring and compassionate with my clients, while tenaciously fighting to retain as much of their assets as possible while quickly eliminating their debt. Brian's extensive experience and knowledge of bankruptcy law and willingness to fight allow him to resolve challenges and cases that many attorneys won't. Don't let other attorneys learn on your dime. Rely on the experience of Aho Law Office to help you achieve relief from your creditors. Competent, compassionate legal advocates providing the clarity to protect tomorrow. For more information, call Brian and his staff at 612-271-4047 or email Brian directly at brian@aholawoffice.com. Again, that number, 612-271-4047.
Todd Rooker here to tell you about the most amazing jewelry store, Golden Treasures on 805 Grand Avenue in St. Paul. I've known the owner, Todd Gimble, for almost 20 years now, and at Golden Treasures, not only do you get more for less, it's the experience that you and your special person will feel when you walk in the door. Todd truly puts his heart and soul into creating your experience regardless of how much money you spend. This is Todd's customer for life philosophy. Take it from me, there really is no other jewelry store. You can't go wrong with Golden Treasures in St. Paul. 651-227-2711. That's 651-227-2711.
Are you looking for a bank that supports entrepreneurs like you? If you're searching for a bank to grow with you and your business, I would like to welcome you to our Village Bank. Hi, I'm Alicia Webb, President and Vice Chair of Village Bank. I'm honored to lead Village Bank, an entrepreneur's bank that was built by an entrepreneur and for entrepreneurs. Starting a business and then maintaining it requires mindset. It's important for business owners to realize that financial statements aren't just for their bankers and accountants. Knowing your numbers will help build the foundation for you and a healthy and successful business. You don't have to be a financial expert nor a banker, but you do need to understand a few key financial documents and metrics to make your business successful. Follow us on Facebook and LinkedIn or visit us at villagebankonline.com. It takes a village to accomplish your business goals. And be sure to tune in to Cover Your Assets the last Saturday of every month to fill your entrepreneurial cup of ambition and start your Saturday off right with me, Alicia Webb, and our Village Bank.
Fix Auto has been the collision repair leader in the Twin Cities for over 40 years. Hi, I'm Matt Feehan, second-generation owner. Our mission at Fix Auto is to provide you with the simplest collision repair experience anywhere. If you're in an accident and you need help, my team is here and ready for you. You can find us on the web at fixautousa.com. That's fixautousa.com. We are Fix Auto, home of the WOW experience.
Hi, I'm Kimberly Nybo with the Kimberly Nybo Insurance Agency, serving the community for over 27 years. People tend to be most concerned with price. That is, of course, until something goes wrong. Then the only thing they care about is their coverage. My experience enables me to uncover every available discount. I could save you up to 40%, while still offering the proper coverage for the people you care about. Call today for a free review at 763-571-6111 or email me at kim@kimnybo.com.
You're listening to Cover Your Assets with Todd Rooker.
Welcome back, everybody. So we left, and we have very little time, but Jim brought up a point that is so interesting, and he said, we were talking about the mortgage. Should I take my retirement funds and pay off the mortgage? And he talked about turning something on. So go ahead and add to that, Jim.
Yeah, I think another approach would be if you're open to the 401k taking care of the mortgage, instead of reducing or eliminating the principal, turn on income to make the payments. Match the income stream so you can make that payment on that debt, and that may be a better situation for our listeners.
While preserving that money to continue to work.
Exactly.
So, the income stream is a much lesser amount than taking all of the money to pay all of the mortgage. It's
Absolutely.
just a great strategy. So if that's your concern, you don't want a mortgage, this is probably a better way to do it. We're running out of time here. And so I want to, again, make another point. Jim does a free retirement plan analysis. It is literally one of the best values you can get. Go ahead and get a hold of Jim. His phone number is 763-657-1828. His website address is enterretirement.com. His email address is jim@enterretirement.com. Jim, thanks for being on the show.
Thanks for having me, Tom.
We're out of time. Have a great weekend, everybody. Bye-bye.
Hello, I'd like to talk with you about financial coaching. Traditional financial planners help you make decisions about stocks, bonds, and mutual funds with money you already have. That's great, but who helps you accumulate more money in the first place? Who helps you make day-by-day life decisions? Who isn't trying to sell you something? Like, should I go back to school? Am I wasting money on insurance? How to purchase and finance a car, boat, home, lake cabin, or investment property? How to start, manage, and sell a business? It's about making minor errors that become colossal mistakes and cost you hundreds of thousands of dollars over your lifetime. The problem is that you're so busy pursuing